over, we dey go harder. We taking over, we dey show Ghana. We taking over, we dey go harder. In a kojo gra bajo, in a kojo gra je bankuda de. Muhammad Ali bumu aye, macho man one cheetah de. I guess all I shake more cafe. We're living on the mortgage. I can't check cafe no be it.
Me I'm in here this year run away. I am in life, so me a girl I'm sick. My old day now be put me away. Me de me yet to be chow kule. We need veggie and you check kule. Ya bremo and you to be. Se me do kakra wo fa go pay. Boss na ya my mate no see away. Captain add what them I say.
Me I no want talk anything. Money they call me for my brain. Yamba kinchiki ya de. Nasa yanzu kungani. This time me I go the party. I the self kungani. Taking over, we dey show Ghana. We taking over, we dey go harder. We taking over, we dey show Ghana. We taking over, we dey go harder.
All right, thank you all for tuning in to WJC 98.3 FM, your voice and music, your station. My name is Jeff Badu, and I'm a serial entrepreneur and a wealth multiplier. I'm the founder and CEO of Badu Enterprises, and we specialize in a suite of financial services, including tax preparation, financial consulting, credit repair, things of that nature. So definitely thank you all for tuning in to WJC 98.3 FM. This is show Money Talks, where all we talk is money. And today we'll be talking about some of the keys to essentially becoming a successful investor. So I'll just be sharing you some tips and tricks, things of that nature, in order to, find your sweet spot when it comes to investing and things of that nature. And we are live on Facebook. You can catch me live on my Facebook page at Jeff Badu. You can also call into the studio line 773-942-7167. Once again, 773-942-7167. Before that, let's go through a market report. This is actually going to be a quarterly report. So this will be one of the first times we'll do a quarterly report as opposed to a weekly report. So this quarterly report is through Q3, or the third quarter. And just to give you a very, very brief summary, normally we do a weekly market report, but today we'll actually be doing a quarterly report. So essentially, the third quarter was full of ups and downs for stocks, much like the second quarter. Stock values moved in response to the rhetoric from the participants in the trade war between the United States and China. So basically, in the third quarter, we've been having a few issues or a few debates about trade wars, about China and the U.S. battling back and forth, essentially butting heads with each other with, essentially with just about trade, about imports, exports, just a lot of battles going on. And then the Federal Reserve lowered interest rates 2 times during the quarter, which is huge. I mean, this is the first time it's happened in a while. The Fed actually lowered interest rates twice this year, which made investors a little happier. So it shifted the balance. Basically, the trade wars lowered the stock market. The lowered interest rates raised the stock market. So you have a balancing effect going on. And then more new jobs were added. So that's good, but at a reduced rate while wage growth continued. Manufacturing and industrial production remained muted, influenced in part by a waning global economy. Essentially, consumers were undaunted by the economic developments, spending at a steady rate throughout the quarter. So that's another thing too, is consumer spending didn't necessarily really change that much. And then as of the quarter end, Dow Jones up 15.39%. Nasdaq is up 20.56%. S&P 500 is up 18.74%. Russell 2000 up 12.96%. And then Global Dow up 10.40%. The federal funds rate is at 1.75% to 2%. So that dropped by 50 basis points so far this year. So just a few things to note when it comes to that. So now let's get into the presentation. Talking about keys to becoming a successful investor. So the purpose of this, talk, or the purpose of this discussion here is really to provide you some tips to become a successful investor. By a successful investor, I mean somebody who actually makes money, either in the stock market, real estate market, whatever market you decide to participate in. Remember, there's millions of ways to make money. So you get to choose what markets you want to participate in. I'll be giving you some of the keys in order to successfully, or in order to become a successful investor. So investing is a lifelong process. It's not just a today, a tomorrow, a yesterday. It's a lifelong process that requires you to be proactive. You have to be proactive, assuming you don't have somebody who's actively managing. Even if you do, you still have to be proactive. So it requires you to be proactive and to take action when necessary. Meaning, if something is down, if the stock market is down, it's time to take action to buy more. And it's about taking the right type of action, not hesitant action or not emotional actions. It's about taking sensible, calculated risk, sensible action, not action that's just based off emotion. Oh, hey, I'm sad today, so I'm going to sell the stock. That's not what I mean by being proactive and taking action. Being proactive and taking action are when you're making smart decisions, but you're acting in an effective and an efficient time manner. Now, there are a few steps you can take in order to become a successful investor. It's a few steps. Really simple. The very first step, it all goes down to education. You must be able to educate yourself. This goes without question. Whether you have an active manager of your stocks, whether you have real estate property managers, whether you have a general contractor that's managing your project, you have to know what that person is doing. You don't have to know every single little detail about it, but you at least have to have a fundamental understanding of what it is this person is doing, or what it is that this stock is in, or how it's performing. So please, you have to become very familiar with the various investment terms, such as stocks, bonds, mutual funds, real estate, ETFs. You have to become familiar with these terms. That way, if somebody mentions them to you, you can say, oh, okay, well, this is what that does. That way nobody's selling you anything that you don't even know about, you've never even heard of. And how you do this is you read books. So read books like Rich Dad, Poor Dad, Money Master the Game by Tony Robbins, Cash Flow Quadrant by Robert Kiyosaki, the real book on real estate by Robert Kiyosaki. I mean, these are the types of things that you can do. So read books, read articles. If you need somewhere to find articles, you can visit my website at jeffbadu.com, jeffbadu.com. Once again, jeffbadu.com. You can visit that website, and it has tons of articles, about over 30 articles now that's written on the website. And then also you can attend different investment seminars. They have a lot of real estate workshops and things of that nature that go around. So the key is you have to educate yourself. You have to become someone who's educated. You don't have to be the most interested into this or vested into it, but you at least have to have a fundamental, just a basic understanding even is enough. And understand the two reasons why we invest. We only invest for two reasons, really. We invest to try to fight inflation. So inflation essentially is the diminishing purchasing power of your money. So money devalues essentially, or the ability for you to buy more, goes down over time because things get more expensive. So with that, we need to be able to have our money grow at least at the pace that our money is diminishing by. So inflation is the diminishing purchasing power of your money. Essentially, it reduces our purchasing power. Second reason why we invest is to take advantage of what's known as compound interest, also known as the most powerful force on the universe, according to Albert Einstein. So compound interest is essentially money that grows on top of money. It's the accumulation of money. It's when money keeps growing and growing and growing and growing. You know, a dollar that earns 5% a year from now, you have $1.05, you know, or $1.05, and then you take that $1.05 and it earns another 5%, then another 5%, then another 5%. So money that just keeps growing. It's like a freight train. You know, it's more powerful than a train that's actually going full speed. That's how powerful compound interest is. And remember, investing is risky. Anything in life is risky. Me being on this radio show right now is risky. You know, me putting my phone on my ear is risky. Me crossing the street is risky. Anything in life you're doing right now is risky. You watching this presentation or this talk right now is risky. Your eyes can go out. You know, or you listen on the radio, your ears can go out. Everything is risky. However, we always have to make sure that we're taking smart, calculated, manageable risk. It's not just because, a stock is risky. People ask me, is the stock market risky? And I say, well, a child crossing the street is much riskier than somebody who's investing in the stock market. You know, so that's how I always like to put it. Risk is simply something that it's what you make of it, ultimately. So investing is risky only if you don't know what you're doing. If you don't know what you're doing, then of course it's going to be very risky. You know, so if you don't understand what you're doing, then yes, it will be absolutely risky because you don't know what it is you're doing. You don't know how to make money. You don't know how to, what strategies are in the stock market. You don't know what stocks are hot right now. You don't know these terms. If you don't know what you're doing, then of course, it's like it's literally like a baby, a baby that just learned how to walk and now they're about to cross the street. That's how risky it is of somebody who's investing in the stock market who doesn't know anything. As a matter of fact, the baby crossing the street is riskier than the person investing in the stock market, because at least there are certain measures in place when you invest that prevent you from doing certain things. For example, if you're trading on margin, which means that you're borrowing money to invest, there's only a certain extent that will allow you to trade on margin. And then start setting sustainable and attainable goals. So don't say, I want to make $1 million in a year and you've never invested in the stock market. So set attainable, manageable, tangible goals that are progressively, you're able to achieve them over time. So say, hey, I just started investing in the stock market. I have $1,000. By the end of this year, I just want to make $100 on that $1,000. That's very manageable. It's tangible. You can see it. It's very attainable, and it's progressive. You set a very specific timeline. So always set these types of very specific goals. This is the same thing we do in business. This is the same thing we do in wedding. When we're planning for a wedding, the same thing we do in life in general is we set goals, we set targets, we set benchmarks. So, in other words, I want to invest $100 a month to establish a rate of return of 8% every year. Very attainable, it's reasonable, and it's measurable as well. Very important to have these factors when you're setting your goals. Don't just set wild, goals that that you can't achieve. Not saying you shouldn't aim for the sky, but understand that just be realistic. Be true to yourself, and then understand your time horizon, whether you'll be a long-term versus short-term. Always make that decision. Me, I'm a long-term investor. I'm always in it for the long run. I'm not in it for a quick dollar. I'm not in it for 6 months. I'm in it for 30 years, 40 years, 50 years, to the day I die and pass. So just something to keep in mind when it comes to this. So younger people tend to have a longer time horizon, than older people, so they can afford to make riskier investment decisions now as opposed to later. And then understand your risk tolerance. Very important. Understand your risk tolerance. Younger people tend to be, more risk-seeking or aggressive than, let's say, somebody who's older, approaching retirement. The closer you are to retirement, the less riskier you should be, because then you can't really afford. If you're 60 years old, you can't afford to lose it all. Not saying you lose it all in the stock market, by the way. You could. But however, just understand that somebody who's of a younger age is more willing and able, most importantly, able to be able to risk some things. And then keep your liquidity needs in mind. Very important. Don't just dump everything in investing. Honestly, I've been very guilty of this. I used to invest everything, basically. But now, really understand the importance of emergency funds, liquidity. It's very important to be liquid, especially when we're about to, when we're expecting something as big as a recession in the next 5 years or so. Not saying that's what's going to happen, by the way. However, it's important to be liquid, especially if you're a business owner, entrepreneur. Just be liquid. Don't try to invest all your money. Understand that you need to have some type of liquidity on hand just in case things fail or, an emergency pops up. So, for example, maybe you want to buy a new home next year. So you need to put more money towards, savings in order to save for the down payment. Or in order to, or you might want to put it in low-risk investments, such as treasury bonds, treasury bills, things of that nature. So always understand your liquidity needs. Liquidity is how soon you need money, like how liquid, how fast you can extrapolate money. So just always understand that. Ensure you have adequate savings. Remember, this goes back to the liquidity. To have money in a bank is very important. You need to have an emergency fund, so make sure, and remember, these are part of the keys to becoming a successful investor. We haven't necessarily talked about the direct investment side, such as, hey, this is the investment you should buy, this and that. We're just talking about steps you should take or some keys you should keep in mind if you truly want to become successful. These are some things I've learned over time. So ensure you have adequate savings, and I'll explain to you what adequate means, or at least some type of savings plan, in order to invest comfortably. It's one thing to make money. It's another thing to make money knowing that you have money there in case things go wrong. So establish a rainy day fund. One of the first steps. Make sure you reserve at least 3 to 6 months. This is something you can decide between, but at least 3 to 6 months of expenses in a form of cash or some type of way you can easily access money. Whether it's available credit on a credit card, just keep it. I prefer you keep it liquid though. Keep the money in the bank. At least 3 months should be in the bank at all times. 3 months of your monthly expenses. And then ensure that high interest rate debts are paid off, or you have a plan of action to pay them off. Why? Is because it can truly drain you financially when you have a credit card that's eating 30% away from your pockets each and every year. I can't tell you a single investor today that I know other than Warren Buffett, who can consistently make 30% every year. So it is very important that you keep in mind that you need to have rainy day fund, and you need to make sure that if you have credit cards, things of that nature, those things are paid off. Not necessarily before you start saving or investing, but at least have a plan. Say, hey, okay, over the next 6 months, I'm going to put $200 towards this card until it gets paid off to zero. Set a plan like that. You don't necessarily have to pay it off immediately, but you have to understand this. The sooner you can pay it off, the better when it comes to these credit cards or these high interest rate debts. Now, if it's like 3%, 5%, you're honestly better off not paying it off or accelerating the payment plan on that. But yeah, essentially high interest rate debts can diminish your ability to invest, or your purchasing power due to high interest rates. So not only are you suffering from the inflation effect, but you're also suffering from the interest rate effect. So just something to keep in mind. And then always protect yourself too. Very important. Be sure to have the necessary insurance policies in place, such as home insurance, auto insurance, life insurance, all that good stuff. And then seek the help of an insurance professional. We run an insurance agency. So if you need help, you have any insurance needs, anything of that nature, we can review your policies. We can get you policies. Contact my firm. It's called Badu Life and Health Solutions, where we provide life and health insurance solutions to different individuals and families. So always seek the help. Usually they'll do this for free, by the way, and just have them review it. Say, hey, is this enough? Give me some advice when it comes to this. And then take advantage of the various retirement accounts, especially ones that come with a match, including a 401k. So in order to have adequate savings, part of it is making sure that you're saving the right way. So try to ensure that you're saving the right way for retirement. And try to contribute on an after-tax basis, especially if you're of a younger age. So if you're somebody that's young, in a fairly relatively low tax bracket compared to where you'll be in like 20, 30 years from now, then please try to save on an after-tax basis. And we do have a question here from Sean Hunter. He said, any advice for managing a 401k? And I would say, make sure that you're contributing at least up to the maximum that your employer will match you. So if your employer matches you 50% up to your contributions of 5%, that means they'll throw an extra 2.5% in your account. So your contribution should be at least 5%, preferably on an after-tax if they allow you to do that. If not, pre-tax is fine. And then you supplement it. So you do up to the maximum. The minimum you should be saving for retirement in general is 10%. So if you're doing 5% at work, then at least another 5% needs to be somewhere else, such as a Roth IRA account, health savings account, or HSA, something that allows you to save, but at least 10% of your gross income should be towards retirement each year. So how do you manage it? You first take advantage of your match at work. You see what percentage. You go up to the maximum possible as far as the match, and then the remaining to get you to the 10%, you do it in the form of an IRA, HSA, or the mix of the two. So that's how I would manage a 401k or retirement savings. And then once you obtain, so first step is, you obtain the knowledge, right? You have to obtain the knowledge. Second step is you start attaining, or you start setting attainable goals. Third step is ensure you have adequate savings in order to invest comfortably. And then the fourth step is once you obtain the adequate knowledge, have the proper savings in place, you can now really explore, or you can get more into. I would expect that you're still investing while doing all these things, by the way. But once you really got it down packed, then you can start really exploring different options and set up an investment game plan going. And this means that you can look at different long-term investments, including dividend-paying stocks where you're getting paid dividends every quarter or every 3 months, such as AT&T, General Electric, all these companies that pay dividends. You can look into ETFs or exchange-traded funds, which are essentially a pool of stocks, from just a different mix. So, for example, the S&P 500 Index Fund, which has the mix of the S&P 500. S&P 500 is composed of the top 500 companies in the U.S. So you can have ETFs. ETFs are nice, pretty easy to control. Then you have mutual funds. Not a big fan of, but hey, they're still out there. You can buy and hold or buy and invest in Bitcoin and other digital currencies. Cash flow and real estate, my personal favorite out of all these. Specifically rental properties, multifamily rental properties or apartment buildings. Peer-to-peer lending, so you can lend money to people on platforms such as Lending Club. Bonds, not really the biggest fan, but bonds are the ability to loan money out to somebody and they pay you back over time. You also have car rentals, so the ability to start a car rental business on sites like Turo. Permanent life insurance, such as whole life insurance, universal life insurance. The ability to build cash value over time and still have a death benefit when the unfortunate happens. You can have annuities that pay you out for the rest of your life once you turn on or activate the annuity. So those are just some examples. Remember, we have presentations specifically on investments. So today is more so focused on the concept of how you become a successful investor or the steps you should take. And the other presentations are meant to dive deeper into these specific investment vehicles. Then you have short-term investments, which I'm not a fan of, but that includes day trading stocks, Forex, even Bitcoin, wholesale and fix and flip real estate. Have to be careful in the state of Illinois now as a wholesaler, of course. Or anything that's within a very short period of time, whether it's, I would say, anything within 1 day to a year. It's pretty short term to me. And once you've done that, once you've attained the adequate knowledge, and once you've started exploring these options, then you can really implement the plan and start allocating funds based off your risk tolerance or based on your risk tolerance, as well as your time horizon. Remember, you always want to analyze where you are in your career. whether you're this age, that age, approaching retirement, all that good stuff. So, for example, 50% of the funds would be allocated to dividend-paying stocks, 30% to ETFs, 20% to peer-to-peer lending. You can mix it up however way you want. For me, real estate is where my bread and butter is, because I know that's what I know the most in, so that's where I spend, or that's where most of my allocation would be in real estate. I also have businesses, for example, things of that nature. And then, so once you implement it, make sure you monitor the plan and keep track of it. Analyze the performance over time. See how you're performing. Are you doing good? Are you doing better than you expected? Are you doing worse than you expected? How is it that you're performing when it comes to this? And then also, make sure you're reallocating assets or rebalance. They call it rebalancing your portfolio. This you might need the help of an investment advisor. But hey, if you really, really know real estate, then, so be it. So ultimately track rates of return, and then ensure that you're comparing them to your targets. So how are you performing against the market? You always want to see how you're performing against the market, because if you're performing worse than the market every time, then you might be doing something wrong, or you might just need to put money in an index that just tracks the market. I mean, if you're doing worse than the market, why not just put the money in an index that tracks the market? I mean, doesn't that make sense? So just to really recap what we've talked about today is, in order to become a successful investor, or some keys to becoming a successful investor, is you first really must educate yourself. You must really say, hey, I really need to educate myself. I'm going to start learning about stocks, bonds. It's upon you as a person to educate. It's not a financial advisor. It's not, it's upon you. You yourself have to go out and say, I want to educate myself. Now, you don't have to get that education on your own, but you do have to make the decision to go out and get that education. Meaning, you don't have to go on YouTube and look at everything. You can attend courses, you can read books, you can get a mentor or coach. So critical to get a coach, a financial coach perhaps. Somebody that can really teach you about these different topics or these different investments. So you don't have to go it alone, but you do alone have to make the decision as far as whether you want to take your investment serious or not. So you have to educate yourself, start becoming familiar with terms and all that good stuff. And then you have to start setting goals. Set a goal of what you want to be a year from now, 3 years from now. Just start setting attainable goals. And then you need to make sure that you have adequate savings. Make sure you have a budget that can help you determine your disposable income, and also help you determine, have adequate savings. And then make sure that you explore different options as it relates to investments and things of that nature. Then begin implementing the plan. So once you've determined a plan, or you have a game plan going, start building or implementing the plan, and begin allocating funds appropriately where they need to be. And then last but not least, you need to always ensure you're monitoring and you're updating your plan, when it comes to that. And here's just a few last minute tips. A few words here. So tips: never go it alone. Remember, you alone have to make the decision, but you don't have to go it alone as far as after you've made the decision how you're going to get to where you need to be. So don't go it alone. Do not go it alone. Get in investment groups, get a coach, get books, sign up for workshops, seminars, all that good stuff. Don't go it alone. Always have good advisors on your team. And then don't just hand your information to an advisor and just say, here, do everything. Don't just hand it to them and not be proactive. You have to make sure you're proactive. You're monitoring this advisor. You don't have to do this every day, but at least on a quarterly or annual basis, ask them, hey, how did I perform? How did I do against the market? So always ensure transparency. I understand that some people might not be most interested in this. Of course, they'll be much rather interested in staying at a job for 10 hours a day rather than how their actual investments are performing. How that makes sense, I don't really know. After all, you're trying to make some money. So if anything, spend some time. You're talking about hard-earned dollars that you've worked over time to make, and you're putting it away towards investing. For you not to care about it, or for you to just say, hey, go figure it out, or hey, just take my money and just do whatever, and 5 years later, 10 years later, I'll see where it is. That's not smart at all. You have to be proactive. It's like working with a wedding planner. Just because a wedding planner is planning a wedding doesn't necessarily mean that you shouldn't be involved in the process somewhat. Whether you're just asking questions like, hey, what's the status? So you have to have experts on your team that will be the main guide of everything you do, but don't just let them control the show all the time. Like you have to make sure you have a say in it, or at a minimum you have to make sure you know what they're doing. And that's how these people get, defrauded and all that stuff, is because they're not, for one, they don't really care. To be honest, it's more of a care thing. If you're not looking at your money, or if you're not looking at your investments, then that means you don't care about them. So that's truly, like, you really have to make sure that you establish that care, and then you're making sure that you're monitoring these people and what they're doing. And then, now remember, you don't have to be asking them a million questions. Hey, why did you do this? Why did you do that? I'm not saying that. At a minimum, what I'm just saying is just monitor what they're doing. See how you're performing, where you started off at the year, how you ended off. And then you can say, okay, why did I perform lower than the market? Then they can have some explanation. So at least you have to know those things. But I wouldn't expect you to say, oh, hey, why did you, just, you don't have to ask the super technical questions. You can if they're willing to answer them, and they should be willing to. But at the same time, you have to let them do what they do best, and you just monitor their performance. So never go at it alone. Never go at it alone. Have good advisors on your team. Be proactive, and they should serve as a guide or a resource in order for you to get to where you need to be. And then continuously educate yourself. Remember, education doesn't start or doesn't end with that one real estate class, or that that one video you watched about stocks. That's not where education ends. Education is a lifelong process that goes on all the time, whether it's monthly, quarterly, daily, however way you want to put it. If you really want to become good at this, not saying you're doing it alone, but if you want to become good at this and smart, then you have to be taking these steps ultimately. And then watch out for taxes. Don't think your investments are tax free. You have to make sure you watch out for taxes. And always seek the help of a tax professional such as myself. Always run the numbers. Always analyze your numbers carefully or closely. So make sure you're running your numbers, you're analyzing your numbers, and things of that nature. And then do some form of automated investing when you're starting, or even as you become more experienced. For example, sites like Acorns allows you to put money on a daily, weekly, monthly, annual basis, where you basically set it, you forget it, and then always monitor your performance, but you don't have to physically go in there and do anything, as far as the investing piece. So have some sort of automated investing as you're learning more about these different investments. That way it establishes a habit. Remember, habits are everything. Just like we wake up every day to brush our teeth. We wake up every day, hopefully, to take a shower. It's the same thing here. Is we're just setting a habit. We're setting a tone to the point where we're not even thinking about it. You don't think about brushing your teeth in the morning. You just go out and do it. It's the same thing with investing. You can set it where every day you can do $5 a day, $10 a day, $15 a day. Just like you wake up to brush your teeth, this will become a habit. Habits are important in life, especially when it comes to investing. So it's important. The earlier you establish this habit, the wealthier you will become throughout your life. So you need to establish the habit of automated investing. Don't put all your eggs in one basket. It's the rule of diversification. Basically, don't just put all your money in stocks, or don't just put all your money in a specific real estate building, and just a little bit. You can diversify within asset classes, meaning that you can put into different types of real estate, but don't just put it all into one building or just one stock. You can put into different sets of stock. So diversification can be within a specific asset class, such as real estate or a stock, or among asset classes. So just something to keep in mind there. And then next is cash is king. Cash will always be king. Why? Is because somebody with money in a bank has more power over somebody without money in a bank when it comes to money principles. So cash is king. When you have cash, when you have money that's sitting in a bank, you're able to do something with it. Versus when you don't, then now you have to go out and borrow money just to live. That's pretty dangerous living right there. So don't forget to keep your reserve fund up to date, or reserves up to date. Remember, we use a 3 to 6 month rule usually when it comes to reserve funds. And then don't dive in with both feet, as Warren Buffett would say. Just dip your toes in the water just a little bit. Don't just dump $1 million into a stock fund when all you have is $1 million. Maybe start with 1,000, 10,000, something relatively small that you don't mind losing, at least in the beginning. Now, if you know for a fact that you can cash out on this one stock, then you're fine to do that. But in the beginning, start small, but think big. Don't just dump it all in there in the beginning. As you learn over time, as you gain more experience, and as you increase your odds, remember, this is all calculated risk that we're taking. As you increase your odds of making a successful investment, then that's where you start really putting these big investments or these big dollar amounts in there. And take advantage of technology. Very critical. Your smartphones, our smartphones have apps. There's a lot of different things that we have. So take advantage of these phones. Research it. Do your calculations. Monitor. Nowadays, these sites have different apps, such as TD Ameritrade. You can monitor how a certain stock is performing. It's all at your fingertips. It's become so easy in life. So easy. Life has become so easy to the point where I don't think anybody has a reason to complain about life anymore, unless they're going through a disability or some sort of hardship that really just put them out. You have no reason in life to complain about anything anymore. Everything is at your fingertips. Your food, your investments, your entertainment, your clothing, everything is right at your fingertips. Literally, it's here. This device right here can basically run my life. 95% of what I do is on devices like this on a day. 5% is outside of these devices. So life has become so easy to the point that we have no reason to complain about anything, about money, about, there's no reason we should be complaining. What we should be complaining about, if anything, is why we don't know about these things. For example, why didn't I know about an iPhone when it came out? Why did I know about Netflix when it came out? Why did I not know that I could invest in Robinhood? That's what you should be complaining about. But once you know, they say you don't know what you don't know. But once you do know, then you have no excuse at that point. Now you need to set an emergency fund 3 to 6 months. How you're going to get there, that's up to you. But you can always start a plan. The point is that all of these things have become so easy for us now. We don't physically have to go to the bank to deposit cash or checks anymore. We can be, in our pajamas and deposit checks nowadays. It's become so easy. So easy in life. To the point where we really don't have a reason to complain. If we're complaining for the wrong reasons. So don't the point for saying that is don't take life for granted. Be sure to appreciate life. Be sure to take advantage of these resources that we now know. If you didn't know Robinhood, sites like Robinhood that allow you to invest for free at your fingertips, now you know. There's an app called Robinhood. You can download it right now as I speak. They'll even give you a free stock if you sign up through a code, or if you sign up through somebody who referred you. They'll give you a free stock to get you started. Now, if somebody has an excuse for that, I don't know what to say to the person. Oh, I don't have money. You don't even have to start the account with anything. You can literally open the account and basically just let it sit, and then later on you may do a deposit or something. But they'll start you off with a free stock. Acorns. $5 a day. I mean, if you don't have $5 a day to invest, I think you have other problems. So just priorities, and really making sure that you appreciate these things that we have in life. So that was a presentation. Hope you guys enjoyed it. Hope you guys learned something new as usual. We're always live on Facebook. And we'll be back next week. We'll be talking about some more stuff. But I hope you guys gained some insight. This presentation was on different keys to becoming a successful investor. If you have any questions, please reach out to me, 773-679-7198. Once again, 773-679-7198. You can find me on social media or Facebook, any of these sites, at Jeff Badu, JEFFBADU. My personal website is jeffbadu.com. So, hope you guys gained some insight. Definitely thank you all for tuning in to WJC 98.3 FM, your voice, your music, your station. My name is Jeff Badu, and I look forward to continuously delivering you all some content. Thank you.
There is not a lot to do on a Saturday morning, talking to